for the SDCERS Board of Administration for Friday the 13th, May 13th, 2016. And we're going to go into, do we have any, we have a quorum?
We have a quorum.
We have a quorum, okay. And non-agenda public comment. So,
I would like to jump in with one thing. We have a distinguished board member who's been on the board for 5 years now, who is pulling up roots from San Diego and moving to Alabama, that being Mr. Wilkin.
Mark, what did you do to him?
Dick has done such a great job over the last several years. He served a 4-year term and was reelected to a second term and is now 1 year into that. So 5 years of service, and he's at the top of the learning curve. He's mastered everything. I think he could do my job better than I could in many respects. I certainly appreciate all the prompting and questioning that Dick's done over the time. So he's just done a great job. So I wanted to make sure that you all had a chance to recognize him today. I do have a certificate of appreciation that I would like to read, and then I'm going to briefly ask Dick to go in the middle there so that Jessica can take your picture, and then we'll display that in some prominent place that will be sure to embarrass you. So the certificate says the Board of Administration of San Diego City Employees Retirement System hereby expresses its appreciation to Richard E. Wilkin for your advice, collegiality, commitment, and service to the Board of Administration, staff, and SERS members, retirees, and beneficiaries. Thank you for the important part you played in fulfilling SERS' mission to deliver accurate and timely benefits to our members, retirees, and beneficiaries, and ensuring the trust funds safety, integrity, and growth. And believe it or not, all of your board members signed this thing.
Oh, no.
Thanasi threatened not to, but he did. So, but anyway, Dick, if we could come out here and I'll just take a. I know there's some public comment people that are going to talk as well, but anyway, that's what I read.
What about me, guys?
Great, thank you.
all right, I'm sure Dick would like to make some comments, but before we get to that, let's do the non-agenda public comments. So we have Dave Hall, Ron Moskowitz, and Joe Flynn here to speak. You guys want to come on up and...
Thank you. My name is Dave Hall, and good morning to everybody. This has always been an issue. First of all, I'd like to let you know that I'm a retired city employee, and I'm formerly a board member on SERS. In fact, I was preceded Dick in his service on the board, and I just wanted to come by and, on behalf of all retirees, thank Dick for his wonderful work. Been very, very active in sharing information with retirees and getting their perspective and so forth. And the value is, I realize this is a system basically by committee, but it's always interesting to have a variety of perspectives on people that are participants in the plan. The other thing I felt that was really an indication of Dick's competence in serving as a board member on SERS is the fact that he also recognized there are two other plan sponsors, the port and the airport. And during our conversations throughout his 5 years of service, they are always a factor in conversations, and I thought that was very, very an indication of his level of competence. So I wish to thank Dick for his wonderful service as a retiree representative on the board. And it's interesting when it comes time for thanking people, usually it's when their service is done. So what I'd like to do is thank all of you before your service is done for doing what you do. And it's absolutely a wonderful thing. It's very reassuring to retirees because you're managing our future, our financial future. So we greatly appreciate that. The other thing is when I was on the board, we were going through a transition. And any organization that's good or that's excellent wants to get better. And for that, I'd like to thank Mark Hovey and his staff for the continued development and improvement and level of professionalism with SERS staff. That cannot be overstated. So Mark, thank you very, very much. And all of you are a part of that. And again, thank you, Dick. You're a key player, component in the continued professionalization of SERS. So with that, thank you very, very much.
Thank you, Dave.
Okay.
Thanks, Dave. Ron?
Good morning. I'm Ron Moskowitz, President, Retired Fire Police. Everything I was going to say, Mark and Dave just said it. So I'd like to echo what they've said. Dick, you've been just extraordinary for us. And I was really happy with your service. And I think your wife wants to move to Alabama simply to have some more of your time. What I'm going to do is I'm going to cause you to become an associate honorary member of the Retired Fire and Police.
Great.
Our organization was started in 1948, and you're the third honorary non-safety member. And you're following the old guy behind me. So can I approach the bench?
Of course.
Thank you, Ron. That's a big honor. Thank you very much. Wow, that's great. Will this get me out of trouble?
And Joe, you're next.
My name is Joe Flynn, and by now some of you may have already suspected that I am retired. Retired city employee and retired trustee. But I do want to first thank all of you, all of the board members, for volunteering your time and expertise in managing our fund. It is much appreciated. And welcome to our newest trustee, Karina Coleman. But today, I'm here to say goodbye to our elected retiree trustee, Dick Wilkin. During our careers with the City of San Diego, I had the pleasure of working with Dick. Not only was he one of the best and the brightest, but equally important, or maybe even more important, he's a man of principle. So after his retirement, I was glad to see Dick serve first on the City of San Diego Retired Employees Association and then on the SERS board. Dick was Alabama bound a few years ago, but he put his plans on hold to stay and help us work through some problems and to help active and retired city employees here. So we do appreciate your sacrifice. And my deepest apologies to your Southern bride on behalf of all those who had any part in delaying your return to the Camellia State. And by now, Dick, you know that you will be missed by SERS staff and the pension fund and all of the members of that fund. And I don't want to go all John Boehner on you, but I do miss you as a friend. So I will leave you with an Irish blessing. May all your skies be blue ones. May all your dreams come true. May all your friends be true ones and all your joys complete. May happiness and laughter fill all your days for you. Today and ever after, may all your dreams come true. Thank you for everything.
Appreciate it.
Thank you, Joe. Does board have any comments they'd like to make at this time? Ed?
I certainly would. I've truly enjoyed working with Dick. He brings a very interesting perspective. We have not always agreed on everything, but at the end of the day, we understand each other and we walk away, and I think we still like to consider you a friend. I've enjoyed working with you very much. For those of you that have been in Rotary or know Rotary, the motto is service above self. And I'm not sure, Dick, if you've been a Rotarian or not, but I know service above self is something you believe in, so thank you.
Thank you.
I want to say a couple comments, Dick, just real quick. As a fellow board member, few know the sacrifices board members make and the work that goes into sitting up here. And I'll just say, we haven't always agreed. We're not supposed to. But it has been truly a pleasure to serve alongside you on this board. Thank you.
Thank you very much. I would like to make a few comments and first thank the members of the board. It's been a real pleasure serving with you, and one of the things I've really appreciated about the time I've been on the board and the members of the board is that we've been able to be collegial, to disagree, but do it civilly. And as Alan mentioned, that it's important that we have different perspectives and that we don't all agree. That's I think if we all agreed on everything, we wouldn't be doing our jobs effectively. So I want to also thank the retiree associations, the Retired Fire and Police Group, and the organization to which I started, the Retired Employees Association. They have been great to work with. I've enjoyed briefing them, keeping them posted on what's going on at SDCERS, getting their feedback and communicating that feedback to the staff and to Mark here. One of the unique things that this particular position brings is that you're also a retiree, and that's what our purpose as SDCERS is to serve retirees. So it gives a unique perspective which you can provide feedback to Mark and to the appropriate staff. And I want to commend Mark, Cynthia, and the other staff of SDCERS. When I first got on the board, compared that to today, I've seen a dramatic, significant improvement in responsiveness to retiree needs and to members' needs, a dramatic improvement in accountability. That is, returning phone calls, tracking things, being responsive to things, not letting things, things will continue to drop through the cracks, but far fewer today than a few years ago. So there's been a renewed commitment, a new commitment, and I give Mark a lot of credit for this, of providing the tone among the staff of SDCERS towards providing good service to our membership and being accountable. Sometimes I think in many organizations there's a tendency to think that the people that we serve work for us somehow, but we work for them. That's what we're here for, and so we need to be accountable to those people. And again, Mark, thank you for improving the level of accountability and professionalism and service. And with that, I just like to. I want to indicate that I know I have information that there will be an election to replace me, and that there are several people interested in that. I'm very pleased to hear that. And I hope that whoever does replace me continues to serve not only as an effective member on the board, but also with a broader perspective of someone that can provide service, feedback, accountability for retiree needs. And I just been real pleased, and it's been a real honor for me to serve, and I've really enjoyed it, and I will miss all of you. Thank you.
Okay, moving down the rest of the agenda, approval of consent agenda items A through D. I'll need a motion brought up. So Ed Katroser made the motion. I have seconded the motion. I'm assuming no items wishing to be pulled by any board members at this time. All right.
Ready to vote.
Yeah. Technical difficulty on voting.
Just cheat off of Mark. How much do we pay for this new system?
All votes are in.
More than we pay the board members.
Yep.
Thanks, Carol. Sorry about that. And the motion passed 11-0. There was nothing on the audit committee, business operations. We'll move right to item A1 there, election of board president. And Mark?
With this meeting, Alan has now served his first full year as board president, It's a one-year term, and he may be reelected for a second-year term. So if the board so chooses, they can nominate him to run for and to serve one more year. If the board does not want to do that, we can form a nominating committee and revisit this issue at the next month. So with that, I'll leave it open to the board to decide what they would like to do. If you want to have him serve a second year, you need to nominate him.
I nominate Alan for second term president.
That's easy because you're leaving, huh?
We'll need a second.
Second, and I have Dick's in the queue and Tanasi's in the queue. Is that that was just for the nomination? Okay.
I'm just saying, there's so much trouble in paperwork and delay, so let's just go ahead and go ahead. I'll third that nomination.
All right.
So Cynthia, do we need a motion? We can do this through the SDCERS system as soon as we get the wording up here.
It should state the term on here, on the motion.
Motion to elect Alan Arolato as board president.
For the term. Not,
By definition, in the board rules, it's a one-year term.
Okay.
I think we're fine with the way we have it here. So we have a first and a second.
All right, so there's a motion to elect Alan Arolato, myself, as board president. I'll comment for one more year as a term. Mover of Dick Wilkin and a second of Tanasi Priovalos.
Ready to vote. All votes are in.
And that passes 11-0. So, and yes, I did vote for myself.
You didn't trust the rest of us? Is
Yeah,
that what
thank
you
you,
did?
board. I really appreciate the opportunity to serve. I've enjoyed the past year, and I'm looking forward to the next year. So next up on the agenda, we're actually going to change things up a little bit here. We're going to bring investments up right now, and we're going to go through investments. I believe there's some lengthy things here, and we can get through this, and then we'll go back up to the agenda and finish the agenda.
Okay, so on the investment side, we met yesterday, and we have four action items to approve here today. One is a $20 million commitment to the LaSalle Fund for our Opportunity Fund. And then we three items with the two gentlemen at the seat, and the hot seat there. We're going to go over our asset liability review, which is done once every 3 years. So this is an important item for us. And we will also be doing the asset allocation, which is done annually, and then the proposed manager structure, which is done once every 3 years as well. So I'll turn it over to Steve and Phil from Aon.
Great. Thank you very much, Bill, and good morning to the board. It's nice to see you again. I think the last time I saw you was at the board retreat back in February. Happy to be here with my partner, Phil Kavarkas. Phil is our national practice leader from Aon Hewitt's asset liability team based in Chicago. And he's the one that helped arrange, orchestrate, run, and do the analysis for the asset liability study. We will be spending a decent amount of time on that this morning, maybe about 20 minutes or so. Do ask questions as they come to mind. The investment committee and us had a very healthy, productive dialogue yesterday, so they can also contribute to some of the dialogue here this morning as well, and we welcome that type of feedback. We're going to talk about three things today. One, the asset liability study, and that's the base or the foundation of which the investment program seeks to diversify its assets. Then we're going to talk about the asset allocation review, which is step 2 in the process. So once you figure out your mix between risky assets or return-seeking assets and diversifying assets, we want to focus then on those return-seeking assets and figure out what the best way to diversify those investments is, how can we be most cost-effective, et cetera. And then the last part of the review is looking at the individual structure, the types of investment managers that we use, the cost of those investment managers, and things of that nature. And we're always looking for efficiency, driving costs down, diversifying assets, and eliminating risk. Bill just mentioned that the last time that you all did an asset liability study was about 3 years ago, and just looking back 3 years, a lot has changed since that period of time. Your market value of investments was $5.2 billion 3 years ago. Today it's $6.9 billion. Your funded status of each of the three aggregate funds put together was only 67% funded. Today they're 78% funded. So a lot of things have happened, a lot of good things have happened. When we look in the rearview mirror over the last 3 years, we look at your rate of return that the investment program has earned, and it was a 7.7% return compounded on an annual basis, which is a very strong return. Recall that your actuarial required rate is 7 1/8. So we've generated greater returns than that was expected of the investment program. And I believe I said this to you at the February retreat. I say this to your investment committee as many times as I have the opportunity to. We've been reaching into the future a bit, earning those returns from the future and pocketing them today and in the past. And so a look forward or look ahead basis, we think the returns of the investment program will be somewhat muted. And Phil will talk about those returns here in just a couple of minutes. So again, please do ask questions. There are 3 recommendations that we'll bring to you today. One is to ratify the mix of return-seeking assets and diversifying assets that Phil will talk about, and then 2 related to your real estate program and your opportunity fund. One is the elimination of REIT investments, a very small portion of your total investment program, and the other is basically some spring cleaning and realigning some of your assets in your opportunity fund that I'll spend a minute on towards the end of our discussion.
And one thing I'd like to point out, so we're going to go through all 3 and then vote at the end.
All right. Any questions before we begin? Any other comments from investment committee members from yesterday? Okay. Let's go ahead and turn it over, and Phil will do an overview of the asset liability study.
All right. Thanks, Steve. Okay. So when we think about asset liability management, we're seeking balance between the assets and liabilities. Now, we know that the liabilities grow every year as a result of really 2 factors: interest and new benefits which accrue to your participants each year. And the liabilities in total are growing at about 8.5% per year. So we know the liabilities are growing at 8.5% per year. We need for the assets, if the plan were fully funded, we need for the assets to grow at the same rate as the liabilities just to keep pace and keep the plan in balance. You know, the reality is this plan, these plans are underfunded. Plans are about 80% funded today. And if they're 80% funded, that means the assets have to work a little bit harder just to earn the growth needed to keep pace with the liabilities. So everything that we're trying to look at is seeking balance. Everything that we're going to talk about is really depicted in this picture as we try and seek balance between the assets and the liabilities. Now, just to say it, the liabilities grow with 2 key metrics: the interest and the new benefit accruals. Your assets will grow with 2 key components as well: market returns and cash contributions or funding into the plan. And so it'll be important to think about how you desire that asset growth. Do you desire the asset growth to come from market returns, funding with cash contributions, or some combination thereof? And as we'll move through these materials, we'll talk about that balance. Okay, page 4, lots of numbers on the page. I'm just going to look at the total for a moment. If we look at the total of the 3 plans, the City of San Diego, the Unified Port District, and the Regional Airport Authority, all total about $6.9 billion of assets across those 3 plans. Now we can see the liability is more like $8.8 billion, 78% funded on the market value basis, and you can see that the bottom 2 rows, the liability growth rate, 8.5%. Right? So on average, these plans are growing at about 8.5%. You can actually see that there's a bit of a difference if you look across the plans. The City of San Diego plan growing at about 8.4%, the Unified Port District 8.9%, and the Regional Airport Authority 11.7%. The Regional Airport Authority is the least mature plan of the group. It has the highest growth rate of the group. It's the youngest plan. Now, as a result of the funded ratios, and you can see the funded ratios across the page as well, 78% for the city plan, 82% for the Unified Port District, 99% for the Regional Airport Authority. As a result of that funded ratio, we can deduce the required asset growth rate, or what we call the hurdle rate. And it's simply the ratio of the liability growth rate to the funded ratio. So for the City of San Diego plan, the required hurdle rate for the assets to keep pace with the liabilities, 10.8%, 10.9% for the Unified Port District, and 11.9% for the Regional Airport Authority. So in total, the required hurdle, about 10.8% for the 3 plans in their totality. Okay, so that's the starting point. We know that the assets need to grow at least 10.8%, 10.8% or more, just to keep pace with the liability growth. Now the question is this: what portion of the 10.8% necessary asset growth should come from investments, market returns, versus funding, cash contributions? And we'll talk about that as we go. Now, the current policy is 78% return seeking, 22% risk reducing. And so we studied that plan within the investment policy within the context of the pension plans. We've also studied a variety of other strategies, which we'll talk about as we move through the materials. Okay. Factors which impact the pension plans' investment horizon. We know that in 2012, the SDCERS closed the city plan, except for police. And so we know that the time horizon as a result of that plan close was impacted. Okay? But we also know that the implication in terms of the time horizon being reduced was very small today, and that will grow over time. So today, we recognize the existing employees within the city will still plan on average, accruing benefits for 20 plus years. And then even those people, once they retire, we expect them to live another 20 plus years. So there's quite a long time horizon for the existing participants in the plan. Now, these time horizons that I just stated will decline over time, right? Because the plan's closed, the time horizon is no longer infinity, right? It's now a finite time period. But that's long today, and it will tend to shorten over time, slowly but surely. Okay, so still long time horizon. When we and we recognize that there are things that could happen that could shorten the time horizon. Generally speaking, any drastic changes to the liability characteristic, like a plan freeze, for example, could change the characteristics of those time horizon. If something like a plan freeze or other change to the liability characteristic were to occur, you might want to rethink the strategy, the management strategy of the assets relative to the liabilities. But as we see it, given the long time horizon, given the existing 78% return-seeking portfolio, we think that, given the long time horizon, the 78% allocation to return-seeking assets makes sense. Again, as long as you're comfortable with the risk associated with that type of portfolio, we think that portfolio makes sense for a number of reasons, which we'll describe as we go. Okay, so we performed a number of analytics, and fortunately we won't bore you with all the details in this discussion, but I'm going to talk about two key things that we analyzed, which will help paint the picture. The first is portfolio theory analysis, and here we're looking at the efficient frontier. And the graph on the top of the page shows on the vertical axis the expected return on assets, and on the horizontal axis the expected risk associated with these portfolios. The curve represents the frontier of portfolios from low risk to high risk and everything in between, which optimizes the risk-reward trade-off in terms of return and expected volatility. And we like the existing portfolio because it lies on the curve. It is well diversified, and it offers good return per unit of risk. Here I'm looking at the first row of the table, and you can see that the current 78% return-seeking portfolio has an expected return of 6.8%, according to our assumptions, with volatility of 11.9%. So what does that tell us? It tells us that the return is, by and large, about 7% per year expected, but that's not a certainty. In fact, there's quite a wide range of potential outcomes. In fact, a one standard deviation event on either side would be as low as minus 5% return or as high as plus 19%. And so that range, you can expect to fall somewhere in that range 2/3 of the time, between a minus 5 and a plus 19. So quite a wide range, right? It's important to recognize that you're taking risk in the 78% return-seeking portfolio in order to defray some of the cost over the long run. Now you can see how that lies on the full spectrum. It's closer to the risky end of the spectrum, but it's not all the way there, and that's pretty common for public pension plans. Again, the longer the time horizon, the more you're incentivized to take risk to defray long-term costs. Now, just to say it, to the extent the time horizon would diminish over time, that would probably push you, and this isn't a today thing, it's probably over the longer run, probably pushes you towards the left end of the spectrum over time, but we don't think that's happening anytime soon. Okay. All right, so that was the portfolio theory analysis. The last thing I'm going to cover with regards to the asset liability study is the economic risk-reward analysis that we ran. And here you can see some summary statistics for the City of San Diego Plan, the Unified Port District, and the Regional Airport Authority. We've defined long-term economic cost as the present value of contributions over the 30-year projection period, plus the ending shortfall. So for example, if you were to fund $2 billion into the pension fund over the 30-year period, and at the end of the 30-year period, we projected that you'd be $1 billion short, we'd call that economic cost $3 billion, right? Because you funded $2 billion, but you still have $1 billion to go. Okay, so we're defining economic cost as the combination of those two factors. And you can see the current 78% return-seeking portfolio for the City of San Diego has an expected economic cost of $3.258 billion over the next 30 years. Okay, that's the expected case. In the worst case, it could be double that, $6.2 billion. So what are we saying there? We're saying that in the 95th percentile of our 5,000 economic trials in our Monte Carlo simulation analysis, so a very bad scenario, very bad scenario, we can see your cost essentially double. Right? So if the world treats us as we expect, about $3 billion, if the world is fairly dire over the next 30 years, $6.2 billion. Okay, so that's the City of San Diego plan, and you can see that you can take risk off the table. You could move from the current 78% return-seeking portfolio all the way to a 60% return-seeking portfolio, and that has cost and risk implications, right? There's going to be a higher cost associated with that move and a lower risk, and conversely, you could move up the risk spectrum to a 90% return-seeking portfolio, and that would reduce the expected cost but increase your risk. Okay. So that's the trade-off at hand. And you can see that trade-off plays out for the City of San Diego, the Unified Port District, and the Regional Airport Authority. As we see it, though, as we studied the projected financial trends, we saw that the current portfolio strategy was expected to regain fully funded status in the City of San Diego plan and the Unified Port District over the next 20 or so years. Right? And we saw that that was shooting fairly steady at the mark. Lower risk portfolios tended to undershoot the mark. In fact, the 60% return-seeking portfolio never quite got to 100% funded, whereas the 90% return-seeking portfolio well overshot 100% over the course of the 30-year projection analysis. So it's almost as though the 78% return-seeking strategy was just right. And so that's how we deduced the recommendations that we put before you. So the longer the time horizon, the more you're incentivized to take risk, the more favorable the risk-reward trade-off is in economic terms. So we like the portfolio from that standpoint. We also like that it's well diversified. And ultimately, the question is yours. The question in terms of the balance of cost versus risk. How much risk are you willing to take? How much cost are you willing to incur? And what's the right intersection of those two things? But as you sit today, we think that the current portfolio makes a lot of sense.
Two key things that Phil mentioned that I think are just worth mentioning again, and one is that long time horizon. We've talked a lot in the investment committee that the city plan is closed. Doesn't that mean the time horizon is shortened? Well, in fact, you still have a long way to go, 20 years or so, maybe even 40 years of paying benefits out. So the time horizon is still sufficiently long. We do these every 3 years so that we can revisit all the assumptions, and we could look at demographic changes, we could look at changes in the investment program and how performance has changed and how contributions may or may not have changed as well. So we'll be back in 3 years and doing this again and seeing if that is still the case, if the time horizon is still the case. And the other thing that the investment committee has been spending time thinking about is we do have 3 distinct separate plans. And despite the fact that we only went through only a few pages here, we had a very robust discussion yesterday and looked at the circumstances of each plan. Phil mentioned the asset growth rate, that key determiner in terms of how the key determiner of whether or not we should combine all three plans. And the asset growth rate for each three plan is very similar, 10 to 11% or so. And that's why we think it continues to make sense to manage the assets in aggregate instead of carving out the regional airport authority because of its higher funded status. So we consolidated a lot of discussion from yesterday into just a few short minutes today. There was a lot of great commentary, great dialogue with the investment committee. Any questions from the board? We have a couple of other items to cover, if not. So once the time has been spent on determining what the right mix between return-seeking and risk-reducing assets, we want to look at that 78%, the return-seeking assets, and figure out what the right asset allocation is. And many of you have heard us say this before, that this is the most important decision that the board makes in our humble opinion. We do visit this on an annual basis. This time around, we don't have recommendations for change, that we don't think that there's anything that needs to be altered in your asset allocation. Excuse me. The expected return for the investment program is 6.8%, which Phil had mentioned. We looked at the liquidity of the investment program, and the liquidity of your investment program remains very, very stable and very high. And so you can take on investments in private equity, private real estate, and things of the such. Let me pause there to see if there's any questions. Okay. There is a recommendation on the table of eliminating your REIT exposure. REITs currently represent 1.2% of the total fund, or $79 million. And REITs no longer serve a necessary purpose in the investment program. They were first put into place about 28 years or so ago, or 25 years ago, to provide you with liquidity and elements of diversification. And your real estate investment program has matured to the position where we no longer think REITs are a necessary component. So that is a recommendation that we're seeking your vote on in just a minute. I could use water. Pardon me, I apologize for this. So the next slide is this. Thank you very much. Eliza, you're the best. Thanks. All right. Your dry weather is not good for my throat. I usually drink about 2 or 3 of those when I'm with your investment committee. So, all right, much better. So structure review, this is the last element that we talked about yesterday, and this is how we go about diversifying the assets. What types of stocks, bonds do we want in the portfolio? What types of active versus passive management? Are there any unintended biases in the investment program that we want to manage? We spend a lot of time looking at those types of things on a quarterly basis when we're in front of your committee, and when we look at performance and when we look at the risk profile of the program. The short answer is your program structure continues to remain largely very well diversified, very low cost structure. Over the last 5 years or so, a great deal of change has taken place. We increased indexation significantly in U.S. equity, non-U.S. equity, and in fixed income, driving your costs down. And we've made recommendations to increase some of your exposures in things like private equity, infrastructure, and further enhancing your real estate program. So the idea was where we think we can add the most value in these private assets and less liquid assets, we want to spend our time, we want to spend our fee dollars in those areas and drive the costs down in the other areas of equities. So your structure remains largely very well, very appropriate for the current environment that we're in. We don't have specific changes in the totality of your investment structure. One housekeeping item or spring cleaning item that I mentioned at the outset was changing some of the investments that are currently allocated in the Opportunity Fund and moving them into the Real Estate Fund. And the investment committee is very familiar with the investments in both of those different pools. So we're not changing the risk profile. It's more of just how we account for assets and how we do some of the bookkeeping on your investment program on a quarterly basis. In July, we will come back to you with our real estate consultant, Che Hong, and go through a very specific detailed recommendation to the investment committee on exactly what is moving, when it will be moving, and other investments that will be made in the real estate program over the next year or so. So it'll be done very methodically, sequentially over a period of time. So I'm going to stop there and get another quick drink of water. And then we ask for your vote on 3 items that Bill mentioned at the outset: ratifying the 7822 return-seeking, risk-reducing portfolio, eliminate the REIT exposure, which is $1.2 million, or 1.2% of the total fund. That won't physically be done until after the real estate deep dive review is done in July, and then reallocate some of the assets that are in the Opportunity Fund and the Real Estate Fund. That will also be done subsequent to the July Investment Committee meeting.
So basically, what we're saying here is, in these three presentations we just looked at, we're maintaining our path that we're on with our asset liability structure, our asset allocation, and our manager structure, with some very minor changes. It's working for us. I know if you were to look at the last 9 months of our returns on the portfolio, the overall portfolio is flat to down. However, what we've seen on the returns is that where the public equity side and the long-term debt and the fixed income side is down, the alternatives have been up and offset the down. So our diversification strategy and what we're talking about here is working for us, even in a market that isn't very good right now. So I think we're in a pretty good position to move forward. Is there any discussion before we move? We're going to move to the votes take each one at a time. Any further discussion? Okay, so if we could have a motion to move the asset liability review recommendation for 2016.
Ready to vote. All votes are in.
And that passed 11-0 unanimously. So next we will take the asset allocation recommendation that we just reviewed.
Oh, Carol made the motion there. Does that need to come from Bill?
I moved
Yeah,
it.
Carol was quick on the motion button.
I'm trying to recover.
Okay. There we go.
It's a 12-step program.
All right. Bill, you want to see if you can
Okay,
jump
so-
in there and
Yeah, I'll move that we accept the recommendation for the asset liability allocation.
someone need to,
I don't see it.
There we go.
There we go, okay.
Bill, that's you. There we go.
Ready to vote. All votes are in.
And the third motion will be the
That motion
recommendation.
passed 11-0.
Oh, I'm sorry, it passed 11-0 unanimously. And the third recommendation is the proposal for the management structure, and I move that we accept that.
Ready to vote. All votes are in.
And that passed 11-0 unanimously.
I do have a quick question that doesn't affect the discussion we just had. Is 3 years a typical time frame to do this type of review?
3 to 5 is pretty common, or as circumstances change. So if something were to happen of significance at the city, or if the plan were to be hard frozen, or some other event or activity, we might do it sooner. But 3 to 5 is fairly typical.
Or if Dick were to retire.
We'll have to take a closer look at the liability stream at that. Well, thank you all very much.
Thank you.
Thank you, Steve. Thank you, Bill. Now we'll move on to the staff recommendation for a $20 million commitment to LaSalle Asia Opportunity Fund 5. Jamie Hamrick will present that.
Good morning. You have in front of you a recommendation for a $20 million commitment to LaSalle Asia Opportunity Fund 5. This fund is a follow-on fund to LaSalle Asia Opportunity Fund 4, in which SDCERS is an investor. Fund 5 is a closed-end, non-core fund pursuing an Asian opportunistic real estate strategy. The strategy, which is a continuation from Fund 4, is to acquire assets in need of repositioning, redevelopment, and active management to create core properties that can then be sold into the institutional marketplace. It's expected that the fund will concentrate on assets in Australia and Japan, and also seek assets in Chinese logistics where opportunities still exist. I think it's important to note that LaSalle is offering a fee concession for first close investors. If this investment is approved today, SDCERS will seek to enter the first close and take advantage of that fee concession. And with that, I'd be happy to answer any questions that you might have about the fund.
Somebody in the queue.
So I'd like to make a motion then that we move the $20 million investment into the LaSalle Fund 5.
Ready to vote? All votes are in.
And that passed 11 to 0. Thank you. Thank you, Jamie.
Thank you.
And now we'll move to the 2016 Investment Program Risk Assessment. Corey and Anders.
Thank you, Bill. As part of the fiscal year 2016 Management Action Plan, the Investment Department undertook a risk assessment that was previously done in 2011. Now, the scope of the 2016 Investment Program Risk Assessment is to examine the risks related to running an investment program. Now, risk is a pretty big word, and it encompasses a lot of connotations and means different things depending on the situation. So I'd like to start off by explaining what this risk assessment does not cover first. So the scope of this project does not cover portfolio risks. These are things that we look at like standard deviation and tracking error to measure volatility. It also doesn't cover market risks, which are external risks inherent in investing in the capital markets. Now, portfolio risks and market risks are covered by staff and the consultant on a day-to-day basis, and they're also reviewed at the investment committee level. One last thing I'd like to point out is this project also does not cover operational risks. The operational risks are covered under by the audit committee and by our internal auditor. So what we tried to focus on and get our arms around were basically the risks related to running the SDCERS investment program. To do this, we started with the 2011 study as a starting point, and that's included in your package. We also reached out to the consultant to get feedback. We also talked with various investment managers, as well as several other pension plans to talk about what they were doing, get their best practices. One large component was we talked with Aon Hewitt's Fiduciary Services Group, which is a group focused solely on risk assessment for their institutional clients. We compiled all these inputs, and we summarized all those risks into 9 categories. And at this point, I'd like to turn it over to Anders, who will go over those 9 risks.
Thanks, Corey. Good morning, everyone. So as Corey mentioned, we identified 9 main risk areas. Every risk area had a number of sub-risks. We're not going to cover those sub-risks today in interest of time, but this should all be in your write-up material that you have in front of you. Instead, in the write-up, we identified all the risks and the controls that went with these risks. And in the risk matrix that you can see in front of you, it provides a summary of all the documents and processes that we look at and review to kind of control these risks. So with that said, the first and most important main risk area is compliance. The risk here is that the board policies and procedures are not implemented in a timely manner. And we felt this was the most important since non-compliance, as you all know, can have some severe risks attached to it, consequences. The second most important risk we felt was asset allocation. The risk here is that SDCERS selects an asset mix that's not optimal to the circumstances and the goal of the plan. This, as Phil and Steve mentioned from Aon Hewitt, is asset allocation is the most important driver for investment performance. This is a very important thing to get right. The third risk area is investment manager selection. The risk here is that the manager selection process is not thorough enough, which could result in a manager being hired that does not live up to the expectations of the plan. The fourth risk area is investment manager compliance monitoring and removal. So the risk here is that there's a failure to quickly identify issues with managers and take appropriate action should action be needed. And I apologize for this repetitive language, but we'll get there. So number 5 is cash management. So the main risk here is that obviously we cannot pay benefits on time or provide cash for capital calls. As everyone in this room who's a retiree knows, it's pretty important to get that right. Number 6 is the custodial bank. The risk here encompasses basically all aspects of housing assets at our custodial bank, State Street. Number 7 is service provider selection, and the risk here is actually twofold. So the first risk is having a provider that does not provide good service at a good price. Secondly, but equally important, is the risk of poor provider selection leading to the board getting improper or poor advice. And number 8 is securities lending. Risk here is that the SEC lending program does not operate as planned, which could potentially lead to financial losses. And lastly, we have investment education and new opportunities. So this risk, the risk here is that good investment opportunities gets passed up because staff is not aware of them, or because they're misunderstood for some reason by staff. So investment education is very important there, we thought.
At this point, before I go into the conclusion, we'd just like to pause and see if there are any questions by the board on the 9 categories of risk in this risk matrix.
I did have one quick question, and maybe I don't understand the column annual meetings. There's the column across the top, annual meetings, and it would seem to me all of these items would be discussed at your annual meetings, unless I'm not understanding what the annual meeting column is.
So the annual meeting column basically states there's guideline that, or policy that says each manager has to show up at SDCERS office once a year for an annual meeting.
Oh, okay.
And then that's different from what gets presented here at the board.
Thank you.
Okay.
Nobody in the queue?
All right, thank you. Then to wrap up, basically Anders has covered sort of those 9 major risks that were identified. And across the top, as Ed Katroser pointed out, is we're showing all the policies and procedures that are currently in place to help mitigate those risks. And really that's our conclusion, that SDCERS has policies and procedures in place that effectively monitor, manage, and minimize all the risks. Now, the last thing I'd like to point out is that we're striving to continually assess investment program risks and improve our procedures to address those risks. So this risk assessment is just not something we do every 5 years and look at what are we doing with the program, but something we do continuously. Some examples of how we've tried to improve recently were we've enhanced our quarterly compliance report. This is a report that we require from every manager. So we've asked additional questions to ensure that they're in compliance not only with their guidelines, but also with their contracts as well. We've also started an annual assessment review for our general consultant. We've always done a review sort of in an informal basis, but we thought that an annual assessment form would be a nice way of capturing this yearly. And also, per Karina's suggestion, we have implemented a new manager due diligence process whereby we will conduct an on-site due diligence visit once every 3 years or more if we think there are issues with the manager. So in conclusion, the 2016 study has found that there are 9 major risk areas in running an investment program here at SDCERS, and we believe we have the policies and procedures in place to effectively manage those risks.
One thing I'd point out is that I come from the financial services industry, and I've worked in banking and securities and insurance. And each one of those categories has major government compliance organizations. The SEC, is the compliance regulator for securities trading, and insurance is regulated by state, and banks are regulated by the Federal Reserve and FDIC. We don't have a government regulator. So this program that Corey and Anders just went over with us is very important, that we are internally doing our own compliance monitoring here. So it's a very important program, and I thank you for doing that for us.
Something to add to, I guess, that Liza mentioned yesterday was we've tasked our new investment counsel, K&L Gates, with looking over all of our policies and procedures for the next fiscal year. So that's going to be an outside party that's going to come in and review it as well to make sure that they're optimal.
Great. Thank you.
Thank you.
Okay, and lastly, we have investment program status report. Anders will give that for us.
All right. So as of March 31st, the reconciled market value was $6.698 billion. Since the prior board meeting, 8 wires were sent out in the amount of $10.1 million to pay for lump sum payroll benefits. Lump sum payroll payments and operating expenses. 2 wires totaling about $69.7 million were sent out to pay for monthly benefits to retirees and beneficiaries. And in the public markets area, the allocation to Copper Rock Capital Partners that was approved in January at the board meeting has now been funded, and the account was transitioned to Copper Rock in late April. So with that, if there are any questions, I'd be happy to answer them.
Thank you, Anders.
Right. Oh, I see someone waving from the gallery out there. I don't think you're trying to start the wave out there.
Just to follow up on what Anders was saying, I wanted to let you know that we have issued a RFP for a real estate consultant. We expect the responses to be back in June. And just to remind you that now that we've issued that, we are in a quiet period with real estate consultants. So,
Thank you, Jamie.
Before the next item comes up, I wanted to tag on one more thing. As I shared with the board via email a few weeks ago, on May 19th, Liza will be traveling to New York to receive Institutional Investors U.S. Investor Award for the Small Public Pension Chief Investment Officer at their annual celebration. So we're very proud of Liza's national level recognition on how well she's doing. And in fact, just this week, Institutional Investors published an article about Elizabeth Krisafi fights pension fires, and I will be sure to share this with you as well. It chronicles many of the accomplishments Liza's done over the years here. So great job, Liza.
Thank you. I would just like to say, I would not be receiving this award if it weren't for my very talented and hardworking staff, a supportive CEO, awesome consultants, and last but not least, a great board of trustees. You guys are engaged, you ask challenging questions, you support the good work we're trying to do here, and that just really makes it all worthwhile. So thanks to you too.
Thank you, Liza. Okay, wraps up investments.
That's it.
So we'll go back up to business operations and pick up where we left off. Item number A2, staff's recommendation to approve the revised PSC calculator. We have Chiron here. So.
Morning. So Alice and I are here to present new purchase of service credit rates These were last revised in 2014. First, I'm going to just go over some background and then explain why we're changing these rates. And then Alice will go through the tables of rates with you and compare what happened before to what's happening now. On slide 2, so just to give you some background, if you're with the City of San Diego, you can still purchase up to 5 years of airtime if you were hired before a certain date. That used to be the case with the UPD and the APA, but when PEPRA came around in 2013, airtime was shut off. They can still purchase other qualified types like long-term disability, leave without pay. Those are still allowed for the port and the airport.
And those are still permissible for city employees hired after July 1, 2005?
Yes, that's correct.
Yes, okay.
The rates are based on the age and service of each member applying for a contract. They're generally higher, the later you are in your career, the closer you are to retirement, and they're lower the earlier you are in your career. And they're expressed as a percentage of your current salary. So you could have a member, for instance, it might be 20% of your pay. If you want to buy a year of service and your pay is $100,000, the calculator may tell you that you need to pay $20,000 or 20% of your current salary. So there are many different rate tables. We come up with one for each plan, and instead of actually giving those tables to SDCERS, we provide them with a calculator program, which they used to use independently, but now you've embedded it into your pension administration software. And so it used to look like what you see here on slide 4, where you'd feed in the data, and then it would tell you, how many years you're buying, what the rate is for each year, and so forth. But now that's embedded in your system. Here's the formula, and I won't go through the details, but basically you're trying to keep it neutral to the system. So you're saying, what's the value of the additional benefits that you're going to accrue by buying this year of service? And then what are the lost contributions that you may have, say if somebody buys a year or two and that results in them being expected to retire earlier. So it's basically what's the additional present value of benefits from buying a service, and then adding in any lost contributions that we think may happen based on the actuarial assumptions.
I wanted to add that previous elected trustee Steve Meyer claimed that he could read this formula. So I should have bought him a T-shirt when he got stepped off our board with this formula on it. But anyway, Steve was a bright guy.
I got sick after carrying the wine.
I just want to comment quickly here. The reason we show this is we had some very painful and difficult transitions several years ago because prior to this formula, it was effectively a flat rate that we were charging, and realized through our painful transition that that's probably not the best way to be calculating purchase of service credit. And so we asked for the formula, and this is what we got. So,
Yeah, I mean, the real cost it's different for everyone based on how old they are, how much service they have, and before you just had a single number for everybody. So this approach is more complex, but it's more accurate as well. So as far as why we're coming to you with updated rates, the rates, of course, they depend on the individual data for each member who's applying for a contract. They depend on the plan provisions for each tier. And then thirdly, they depend on the actuarial assumptions. And if you recall, for the 2015 valuation, we revised 2 of the economic assumptions. We took the discount rate down from 7.25% to 7.125%. And then we took the inflation down from 3.3% to 3.175%. We also need, since the time of the last update, we've had members now in the Lifeguard 2011 plan, that Tier 2 for Lifeguard, and we have a UPD miscellaneous plan. So we need rates for those 2 tiers. And the intent is that these rates will be effective July 1st, 2016. For better or for worse, the rates will be revised again next year because you also have a scheduled reduction of additional 1/8 of a point in your wage inflation and your discount rate for the 2016 valuation. And then right now we're working on an experience study that will look at, in addition to the economic assumptions, we'll look at other demographic, mortality, retirement, termination, so forth. And so any changes we make in that experience study, we would assume would be reflected in the 2016 valuation and would then be reflected into the PSE rates. And finally, just to clarify what these rates apply to, they apply to airtime and most other purchase types. There's some types like military leave where there's a specified cost, and they don't require the full actuarial cost to be paid. These rates are for purchase types where you require the full employee plus employer cost be paid. And so at this point, I'm going to turn it over to Alice to actually go through the tables and show you.
So we'll go through these tables tier by tier, rate by rate, and see the changes. Okay. So when we look across, if you scroll through these pages and you see the trend of change, the top table has what the current rates are, and we've just bracketed just a sampling of the rates in 5-year age increments and 5-year service increments. And this table below shows the proposed rates, so the rates that we're going to be voting on approving for effective July 1st, 2016. Now, across the board, there were 2 key drivers of change. So the discount rate, and when you take the discount rate down, it effectively increases costs. So we would see these rates increase. When inflation goes down, that's the salary driver, that when inflation goes down, so then the rates would go down as well because the costs go down. Discount rate is more prominent. It's a stronger assumption that's a more significant driver in the value of the liabilities. And so the net impact of those 2 changes in the assumptions actually generally increase the rates. But there were 2 minor details that had a play here. And one of them that all the tiers felt was there was a minor change in methodology that we put into play with the 2015 valuation in terms of handling salary. And the second factor that was here is the positioning that the city, so only for the city, where they are in terms of the freeze. So the prior rates, the current rates, there were still 4 years of the freeze. Now we're 2 years farther in that timeline. Less freeze means that those salaries will be increasing more. And so in the net impact, when we look at all the city rates, and if we compare the current to proposed, the city rates all increase slightly. And when we scroll across and have a look at the rates for the port and the airport, the net impact here, because they didn't have the play there with that salary freeze that drove their rates up, their rates actually decreased, and that was driven by that methodology change in the valuation. So if you'd like, we can have a look at any of these combos for a discussion.
I have a question. So I'm looking at my particular rates. So what should be city fire pre-1112, I assume?
Where am I? There we go. No.
We're getting into my personal business here. What I find interesting is, so at age 50, with 25 years of service, the rate would be 51.4.
Is currently 51.4.
Okay. And it now will be 50.9, correct?
Correct.
And really, it's not so much about the change in the rates. Why the drastic drop from 25 years to 30 years in the purchasing rate? Now, I kind of put you on the spot there, I know.
Well, there's a cap on benefit accruals. And so if you're buying another year of service, you're buying and you're essentially, you're reaching that cap for your benefit. So you're not going to have as strong of an impact. If you are at 25 years, you might not be at your benefit accrual cap.
Okay, so essentially my purchase could put me too close or above my cap of 90% because we can't acquire a benefit greater than 90%.
Right.
And so with that amount of service and the age, I'm so close to the cap that a purchase. Okay, I got you.
Yeah.
I'm not planning on buying any time at this point. I'll work my years. Anybody else? No?
Again, these rates are just illustrative of the formula that we do, which actually interpolates to fractional age and fractional years of service.
Okay, so with that, we have a motion to approve staff's recommendation to revise the PSC calculator and rates of purchase of service credits effective July 1, 2016. I have a motion by Dick Wilkin, a second by Jimmy Steele.
Ready to vote? All votes are in.
And that passes 11-0. Thank you, guys.
Thank you.
So we'll move on to disability. Natasha?
Okay, I think I may hold the record for the shortest meeting ever.
I had like a 7-minute one once.
I think mine was 5.
Oh.
We had 5 items. Item number 4, which was a denial of industrial retirement benefits for Donald Swanson, was continued till the next meeting. The committee approved items 1 through 3 and item number 5 unanimously. Items 1 through 3 were approvals, and item 5 was a denial of industrial retirement benefits, but an approval of non-industrial benefits for Jane Ashton. And as Dick pointed out, we think that that might have been the longest report since. We don't know how many pages it was, but yeah, it was a lot.
Hearing officer report.
Yeah,
yes.
Very thorough. So if there are no questions, I'm going to go ahead and make the motion to approve items 1 through 3 and item 5.
Ready to vote? All votes are in.
And that motion passed 11-0.
Excellent. And as far as the staff reports, I think Sandra made a note that the action that the board took back in the September meeting to allow staff to refer items directly to the adjudicator has actually resulted in, I think, at least 2 of the items being referred. And so that has saved those applicants time because they've gone right to the adjudicator. So that process is clearly working. And that concludes my report.
Right. Thank you, Natasha. All right, moving on to business and governance. Val Hoy's absent today, and so in his place, Ed Katroser will report out from committee.
Great. And just for the record, Val was at the B&G meeting yesterday. He just had to be in court this morning. That's the reason he's not here. We had 3 items on on the consent agenda. All 3 passed unanimously yesterday at B&G. Would any trustee like to pull an item for discussion? Okay. If not, I'll make a motion.
Ready to vote? All votes are in.
And that motion passed 11-0.
Great. Under old business, no action requested. We had 2 items. One, Marcel gave a report on overpayments and underpayments exceeding $10,000. There was 1 additional member had a correction of greater than $10,000, and another member previously reported has paid the principal and has indicated that they will appeal the interest. Under item B2, SDCERS recommendations to the San Diego City Council regarding amending the city's charter. Johnny Tran discussed the status of our recommendations. Once the City Council makes its final decisions, staff will follow up with the board. Then we had the status reports by division. Legal compliance. Johnny highlighted the city's side letter agreement with the MEA concerning the city covering interest owed on underpaid employee retirement contributions for MEA members. The side letter agreement is conditional upon the charter being amended or Proposition B being overturned. Johnny also reported that all board members have filed their annual Form 700s. Dave Bond gave the information technology report. He reported that security enhancements have been implemented to the member portal account creation registration process, making the sign-up process safer than ever. The board high-definition upgrades are installed and are at work for the meeting today, as you could see. Funding for the project comes from the City TV's Public Education and Government Cable Service Surcharge. Member Services, Marcel Rossman reported that Member Services has been working collaboratively with IT, Health and Benefits Administration on several projects, the portal security updates, Health Information Day, and member corrections. Marcel also reported on the Benefits Administration that their testing year-end processes and the implementation of IRIS has greatly improved this process. Lastly, Ted LaSalvia reported that finance is current with financial reporting through March of 2016, including the year-to-date actuals versus budget. Ted introduced Rebecca Shee as the newly promoted Accountant 4, responsible for benefit administration and taxes and investment activity analysis and reconciliation. Ted then went over the March 2016 trust financial statements. At March 31st, SDCERS has a net position of $6.6 billion and total investments of $6.7 billion. For the 9 months ended March 31st, SDCERS had a decrease in net position of $235 million, the bulk of that from our investment loss of $149 million. And then last, Ted reported on March 2016 expenditures versus budget. Our administrative expenses totaled $32.9 million for the 9 months, which was under budget of our $36.6 million budget. Salaries, litigation expense, general ops, and investment management fees were all under budget, so great job by staff on that. And that's my report.
Thank you, Ed. We've already covered investments, so we'll move on to training. Johnny?
Yeah, the board just approved the fiscal year training calendar, so I have left on the planning calendar in case there are ad hoc decisions, something new comes up, and we'll continue to leave that open on the calendars, but I don't have any requests now unless I hear one from a trustee. Yes, Dinesh?
Johnny, I think you had said, you had kindly advised me that Stepstone's conference this year is not even in the country, so I'm not going to attend that one. But the question I had was that you had made a recommendation of 2 others that were of similar caliber or ilk. I just don't have in front of me which ones they were and whether I need approval now for those or not.
You don't need approval now. I can't recall which client conference we had recommended, but I know.
I think one was Aon and one was Invesco, maybe. Does that sound right?
Yeah,
those are.
The Aon Hewitt one is their client conference, which is typically done every other year. Preliminarily, we believe it's going to be in May of 17, but we don't have confirmation of that. But there's plenty of time between now and then to confirm that.
Then no worries on that.
Yeah.
And then the Invesco conference is usually in November.
Okay. Right. Thank you.
Thank you. Well, seeing nobody in the queue, we'll move on. Thank you, Johnny. That brings us to the end of our agenda, amazingly enough, at 9:45. So with that, is there any questions or comments from trustees, staff, in closed session?
I'll
Mark?
just follow up one more thing we discussed right at the beginning of today's session is that with Dick's departure, we are underway on the process to hold an election to succeed Dick, and that election will take place over the next month or 6 weeks. I think it unlikely that we'll have completed that process in time for the July meeting. We'll see. So we may be a trustee short in July, but I think that will still be fine.
I'll vote for him.
Yeah.
Who gets his vote?
Yeah.
That's the question.
That's right. Dick said there was a very, very, very small chance he'd be here in July, so I presume that he would not be here in July.
It's now 0.
It's now 0? Okay.
So you're saying there's a chance?
Well, there you go.
I move that we just simply fly Dick in twice, every other month for these meetings. I don't think that's a big deal.
Yeah. Okay.
All right, thank you. Closed session?
We do, Alan, we do have closed session. You have moved through this calendar so quickly that Dave Noonan, we've asked him to come a little later, and we've called him to come sooner. So if you would call a short recess, then we'll try to get Dave in here as soon as possible so he can discuss the ongoing litigation.
Okay, we will call a short recess, take a break while we move into closed session. Thank you. You hear that? The cameras are coming back on. The cameras are coming back on.
Oh, they are?
I know.
Maybe stop from setting up.
You're talking anywhere from 50 to 150,000. Okay, we are ready.
All right. Coming out of closed session, nothing to report. SDCERS Board of Administration is adjourned for Friday, May 13th.